You watch the market clear a massive multi-month resistance level. Green candles dominate your timeline. You buy the breakout, confident the trend is secured. And within hours, the price reverses, chopping your position to pieces right at the local top. Despite the overwhelming bullish sentiment flooding the market today, the hard data tells a different story. 3 distinct converging metrics indicate a high probability pullback is actively being architected. Retail traders are currently buying the aggressive headlines, but institutional algorithms operate strictly on liquidity, and right now they are exhausted of upside fuel. To understand what happens next, we must look at the Fibonacci reversal zone that hit today, map the hidden downside liquidity magnets waiting below, and unpack the math behind the misleading MicroStrategy sell-off headlines. I'm your host, and this is Crypto Whale Radar. We rely strictly on on-chain data and market geometry to navigate these structures. Surviving the next 48 hours means turning off the emotional noise and strictly trading the mathematical convergence of price and time. Let's start with the exact ceiling we just hit. Over the past few days, Bitcoin rallied aggressively before rejecting sharply at exactly $82,400. This chart shows a geometric overlay on the Bitcoin price action, specifically a 1-to-1 Fibonacci price extension. By measuring the previous major upward swing and projecting it forward, the math dictates the exact ceiling of the current move. That projection sits precisely at $82,400. The price rejected off that Fibonacci level with almost exact dollar accuracy, confirming the geometric structure of this specific move. Identifying the price target is the first step, but we can refine our reversal probability by measuring the market's pace using trend-based Fibonacci time. This visual adds vertical timeline markers to our previous chart. It shows that the exact duration of time elapsed between the recent pivot points perfectly mirrors the length of the previous structural cycle. The timing matches the price. When you see time symmetry converge directly with price symmetry, the probability of a structural reversal increases drastically. The rejection at 82,400 was a mathematically inevitable exhaustion point that advanced traders expected. Zooming in from those macro targets down to the 4-hour time frame, we can measure the immediate momentum behind this push. This split-screen chart displays price action on the top and the relative strength index on the bottom. Notice the anomaly. While the price action actively forms higher highs, the momentum indicator is bleeding out, printing a clear series of lower highs. We call this a confirmed bearish divergence. The asset is creeping upward, but the push lacks underlying institutional volume. If this were isolated to Bitcoin, it might be manageable. But this exhaustion signal is triggering across the entire market. Pulling up the Ethereum data, we see the exact same pattern. The price pushes up, the RSI slopes down, and the entire structure is currently crashing directly into a thick, multi-month horizontal resistance band at $2,400. Major altcoins are following suit. XRP is currently executing a perfect rejection from its exact resistance cluster between $1.45 and $1.47. Technical indicators show us the exhaustion, but they don't dictate the drop. To see exactly where algorithmic order books are dragging the price next, we have to look at the liquidation data. Buying a breakout while the entire market prints synchronized bearish divergences is high risk. The fuel for continuation is completely burnt out. While the charts flash warning signs, the fundamental news cycle is generating its own panic.
The dominant headline causing retail fear right now is the rumor that Michael Saylor's MicroStrategy is preparing to sell its Bitcoin. The common assumption is that the biggest corporate accumulator has lost faith in the asset. That is a misread of corporate finance. MicroStrategy utilizes a preferred equity model known as Stretch, which requires the company to pay a mandatory 11.5% yield to its investors. Their legacy software business operates at a loss. It simply does not generate enough profit to cover these massive dividend payouts. This flowchart breaks down their actual solution, net asset value arbitrage. The company sells a small portion of Bitcoin to pay that stretch yield. Delivering that yield attracts even more investor capital, and they use that new, larger pool of capital to buy an even greater sum of Bitcoin. Looking at the resulting treasury size, the total Bitcoin holdings grow larger with each completed cycle. The localized sales are a mechanism to acquire more. This calculated treasury expansion is entirely disconnected from the dramatic, fear-mongering headlines fed to retail traders about corporate capitulation. Getting this wrong costs you money. Subscribe to Crypto Whale Radar to ensure you are trading on institutional-grade data rather than reacting to Twitter-level hype. The MicroStrategy sales are a tool for aggressive treasury expansion. The long-term macro structure of the market remains completely intact. With the macro noise cleared out, we can focus on the hard data of the order book. Remember, the market recently swept the liquidity pools at 79 and 81,000, wiping out the upside targets. This heatmap visualization tracks leveraged positions. Notice the dark, empty space above our current price. Now look below. There is a densely concentrated cluster of $128 million in long liquidations sitting directly at the $80,500 level. If the price breaks its immediate trendline support, it confirms a 30-minute head and shoulders pattern. That triggers a rapid flush down to grab that $80,500 liquidity pool. Zooming out to the weekly view reveals the structural floor beneath that. There is an exponentially larger cluster of liquidations anchored solidly at $77,500. There is a secondary scenario. The price drops into the $80,500 zone, executes a rapid swing failure pattern to wipe those longs, and immediately bounces. That specific reaction would perfectly fulfill the hidden bullish divergence currently building on the 2-hour MACD. The market does not crash randomly. It is dragged with robotic precision from one liquidity pool to the next, entirely blind to retail emotion. Pinpointing a localized drop is completely useless if your exchange freezes or suffers massive slippage during a rapid liquidity flush. That is why I strictly trade these high volatility setups on BingX. Their execution engine is built to handle these precise liquidity grabs without locking up. You can use the link in the description to claim specific exchange deposit bonuses, and registering through that link grants you direct access to my trading mentorship group. When Fibonacci time and price symmetries are completely exhausted, momentum is printing lower highs, and all the available liquidity is trapped below the current price, you do not buy the breakout. You trade level to level. Mapping accurate reversal zones is useless without disciplined position sizing. Improper leverage during this incoming chop will liquidate you regardless of your entry point. To learn how to size your trades correctly and avoid the #1 hedging mistake when dealing with sideways price action, click the video on your screen right now.